this exclusive webinar for Adarsh residents. This webinar is indeed very, very special, as we also have one of our co-founders of Alphaniti, Nanda, who also is a resident of this elite community and also currently joining us from London. So, the theme for today's session is indeed fascinating, as it is about equity investments in two of the largest global markets, which is US and India. And we have an outstanding panel of highly accomplished investment professionals who will be covering these topics. So starting with John, he is the co-founder of Validea Capital of US and has been a highly respected investment professional and also author of the book Guru Investor and a regular columnist in Forbes as well. He's an MBA from Harvard and a graduate from MIT with computer science. You are but one of India's celebrity fund managers, having earlier been with Jardine Fleming, JP Morgan, and also managing FI funds for the London-based Dalton Capital for a long time. Akshay, he heads our investments and has rich experience of institutional fund management for more than 15 years, having worked with Nomura, JP Morgan, and Kotak. And I have led, built, and established global and domestic fund organizations in India and Asia Pacific. With that, let me provide a quick overview of Alphaniti. Well, Alphaniti is a data-driven, rule-based, and tech-enabled platform which allows Indian investors to invest in both India and US markets and choose from a wide range of product offerings covering stock ideas, stock strategies, as well as stock baskets. Essentially, it straddles three large asset categories. First, US equities, second, India equities, and third, mutual funds. Now, this platform is fully digital and is an integrated advisor broker client platform which allows you to get access to the best-in-class advisory and also seamlessly fulfill your trades through your choice of execution brokers. So through this course of this webinar and session, we will do a quick walkthrough of the platform as well. But before we get there, let me begin by getting John into the discussion. Well, John, as you know, the world in 2021 is looking very different, right? So we had this extraordinary event, a black swan event, the pandemic. And of course, you know, the pandemic still continues to rage in the US and some parts of Europe. And whilst we also saw probably one of the most bitterly fought elections happening in the US and a very polarized nation, it would be really great if you can share your perspective on the US market against the backdrop of a Biden victory.
I'd be happy to, Parinder. Let me see if I can share a slide here on my screen here. You're absolutely right. This was one of the most contentious political contests and elections in recent times, perhaps even 50, 75 years of American history. And at the same time, it actually brought out more Americans to vote than ever before. So the government basically had moved from what was a split party government, headed by a Republican and controlled in the Senate by Republicans, but Democrats controlled the House. There are two branches of our United States legislature. We've moved from that to a non-split government where at the current time, the Democratic Party controls both the presidency, the Senate, and the House. So Biden, in contrast to the president before him, is really trying extremely hard to be inclusive and listening to all parties and trying hard and offering a peace branch to the Republican parties so that he can get some bilateral support on policies that he wants. That said, this is, it's still contentious. He is probably not likely going to get much cooperation. The Republicans are saying anything we do to help you will still come back to haunt us in the next election. So we're going to drag our feet. Part of the backdrop to understand is that most observers and pundits of the United States expected that there would be a split government. And there's some feeling that split governments result in the best long-term performance in the US stock market. So let me share something with you that is actually relevant to that. The market returns under the various political parties have been analyzed, and there are 4 states where all the government is controlled by Republicans, all the government is controlled by Democrats. And then we have divided with a Republican president, which is what we had previously, and divided with a Democratic president. What I want you to see is that the S&P return over these holdings, first of all very positive. The best return actually occurred when there was a divided government with Democratic president. But what I really want you to see is the other situations are not very well behind. So the bottom line, a lot of people worried about this for the US stock market. It's still pretty positive sailing. You should separate your political beliefs and expectations, what happens in your various political parties, from your stock market investing philosophy. It's still safe, basically, to invest.
Right. So clearly, whilst election outcome and political capital is no doubt extremely important, markets, John, do have their mind of their own, right? So the return of 15% plus with a divided house and a Dem president, indeed a great revelation. So given the current backdrop, what do you see to be the next trends and themes which could emerge and dominate the US equity market?
Okay, let me again switch to a slide here. I believe that there are 4 areas that are really poised to benefit most over the next 4 years from the Biden presidency. The first has to do with ESG, or environmental, social, and governance stocks that are selected as a type of company or type of area. And I'll get into that in just a little bit more, but stocks in this area are poised to outperform. Second has to do with healthcare stocks, and that is the Biden administration wants to increase the coverage of Americans in healthcare. There's support for biotech development, support for the vaccine development and distribution. Lots of things are happening with healthcare, and substantial money is going to be pumped into that area. Small cap stocks, and I'll talk about this in a little bit more detail, are poised to have a tremendous reversion, and value stocks that have been overlooked for many, many years in the United States are also poised to have a very, very big reversion. So let me delve into a couple of these factors. I mentioned ESG. If you'll notice here, up through about 2018, the amount of investments measured in the billions of dollars have been relatively flat in ESG. In the last 2 years, the amount of investment in ESG has absolutely exploded. There's an industry association for ESG institutional investors. They are now showing that by one measurement, 30% or 1/3, which goes into like $13 trillion of investment, are now in ESG and ESG types of stocks. So this is still a very hot area. There's research that shows that ESG stocks have been more profitable for investors in terms of returns, and more profitable as a company. It's not 100% consistent. There is some research that doesn't show any outperformance of that, but clearly enough individuals and big institutions believe this, that they're pumping billions, even trillions of dollars into ESG. Small cap stocks have been up really big since the Biden victory in November. If you look at this chart, if you focus on the top two lines, the purple and the yellow, these are the small cap stocks in the United States, the Russell 2000 value since November. And you can see it's dramatically outperformed growth stocks and large cap stocks over this period of time. What's happened is those stocks were hit really big coming into early 2000, and the expectations for the stocks have been low, and they're now coming up very big from the anticipated, economic expansion and reopening of the economy. So this chart shows the from peak to peak of a small cap bull market over the last 12 against small cap bull markets. The middle line here that you're seeing, about a 44% average, is the type of return in small caps over the bull market run. The most important thing I want to call to your attention, in the most recent bull market run, which basically started just in August of 2018, we're still only 17%. We're well under the average of the return for that. So the key point of this is small caps still have quite a way to run to even get to an average small cap bull market outperformance. Reversion of value is another really key story that's happening and occurring for this year and is poised to out benefit. What you're seeing here is a chart of about 10 years following the each recession of the United States. This looks at the 5 recent recessions. We're only 10 months or so, 10 or 11 months into the recovery from a recession. So the reversion of value usually tremendously outperforms over the coming months and coming years. We're still at the early stages of a recovery in value. So this will lead to a greater outperformance and is a great investment area and opportunity. So those are the 4 areas that I truly expect to outperform and continue to outperform over the rest of both this year and over Biden's presidency.
Sure. That was really very insightful, John. And perhaps with these trends as the broader context, it may just be worthwhile to go deeper and look at the products, their performance, and also perhaps an insight into the robust and time-tested selection process that you have for the US stocks.
I'd be happy to do that. We have several top performing US strategies. We have the, first of all, what we call the Findia Twin Momentum Factor Strategy. So this is based on a paper from Dashun Wang on twin momentum strategy. What is unique about this is most people have heard of momentum strategies. The stocks that have been doing well recently will continue to do well. That also breaks down into other sub-strategies, such as the stocks that have done the best over the past year minus the most recent month will continue to outperform for the next year. Dashun Wang took that momentum strategy and looked at the momentum of the fundamental factors that demonstrate the performance and the profit and loss of a particular company. Those are the fundamentals of a company. And looked at the momentum in terms of those trends and compared them against all the other stocks and ranked and took the stocks that had both the highest momentum in the price and the highest momentum in the fundamentals. Created a strategy around this. This has been a big winner. Just for comparison, the S&P 500 went up 16% last year. The twin momentum strategy went up 40% last year. A second high performance strategy has been the Mohanram price to book growth strategy. So in academic research, a high price to book has been associated with a value type stock. Low price to book has been associated with a growth type stock. And academic research really loved these high price to book stocks, these value stocks. Mohanram turned this on its head and looked at what are the factors that allow growth stocks, that is low price to book stocks, to do very well over the coming months and coming years. So he identified the factors that were most successful in helping to identify the growth stocks. His strategy was also a big winner. In last year, it was also up over 42% compared to the S&P's 16%. We have coming a composite value strategy. I mentioned that we anticipate that value is going to be very strong over the next year and over the next several years. And in the not too distant future, you will see an announcement to this effect. But I just wanted to mention that we have something that is covering that. We also have what we call US baskets. Now, these are not based on long-term academic strategies or of the gurus or experts. These are based on thematic baskets. In this case, technology leaders, ESG leaders, and healthcare leaders. And they're very focused that within the themes, they pick the best US-based companies that meet these particular themes. Our technology leaders basket, as you know, technology also had a reasonably good year last year, scored 41% versus the S&P's 16%. I mentioned ESG leaders. This basically hit the ball out of the ballpark and was up 89% last year. I don't want anybody to believe that it's going to have a repeat of such a high number this year, but it merely yet another evidence of a very strong trend within ESG type stocks. And finally, in the healthcare area, we have a basket. It also outperformed the S&P 500, not quite as much as the other strategies, but still very significant outperformance over the S&P 500. Wide moats and big brands are interesting. Then it looks to see the companies that are positioned that have higher than average profits or a very strong competitive position. Maybe they've got the lowest price production in a particular industry. Maybe they've got a bunch of patents that are locked up. Maybe they've got tremendous locked up distribution. But this is something that Warren Buffett likes to see in his investments. So these are the selection in the US of the best companies that have the wide moats. This basket also basically doubled the performance of the S&P 500 last year. And then last is the Dividend Aristocrat basket. There is a style of investing where you're interested in income and you're interested in dividends from it. This has not been, honestly, that popular or that rewarding over the last several years in the US stock market. But nevertheless, when you look over decades of investing, this becomes a reliable, substantial trend. Dividends have, over the years, been a very substantial part of the performance and the return of investing in stocks. The Dividend Aristocrat looks for US companies that have paid dividends over 20 or 25 years steadily, generally are increasing dividends over time, that are companies can be relied on to produce dividends. This usually results in very large cap, very solid stocks. This had a respectable return, 8%. It did not outperform the S&P 500, but nevertheless, for individuals who are looking for steady income and want that income just from the dividend of the stock, this is a good and respectable strategy.
Right. So truly stellar performance indeed, John, and it's been pretty consistent. I would say it amplifies the very deep focus on research, right, that you have as a house, and also the capabilities in identifying the winners, whether it's for your baskets or for your strategies. So why don't we now get into the single stock recommendation engine and the alert system that you have also as a great product offering.
I'd be happy to. So I love this. What we have put together is we looked at all of these strategies and quite a few others that we have over long periods of time to see that when multiple strategies recommend the same type of stock, does it result in outperformance of the next 1, 3, or 6 months? And we found a pattern of alerts and recommendations that do exactly that. So we call this, and let me share this, the Stocksy Genie. Basically, it comes with a particular recommendation. There could be 1 to maybe 3 recommendations a week to buy a particular company at a particular time. So just as one example, there was a recommendation of the ticker PERI. So far in this recommendation, it's been up 95%. This was a recommendation that had a 3-month return. And again, so far is still going very strong. So this is an example of the type of alert or recommendation that it does. Here are some other top performing Genie alerts. Again, this is just from the past few months. Each alert, again, I will emphasize, comes with a recommendation to hold it either 1 month, 3 month, or 6 months. So let's just say 3 months on average. These are selected, obviously, to be the best returns. On average, you're going to have somewhere between a 52 to 57% success rate. So I don't want to give the impression that every single alert is definitely going to be a winner or show these kind of great returns. But again, this shows the very, very strong and exciting potential. And you've got returns, again, even in this short period of time, ranging from 25% up to as much as 135%. You can again see the start date and recommended end dates for each of these positions. A number of these have actually closed out and are actual performances. So I'm very excited by this new Stock Genie alert system. So what are the key advantages? Why do you want to do trade alerts? One is you know exactly when to buy and when to sell. It removes the guesswork and removes the emotion. This strategy is covering all of the stocks in the stock market view compared to all other ones. It's looking on an everyday basis. So it's doing hundreds of hours of research that would take a individual to do. And even then, an individual could not cover the whole stock market. In addition, it's got the entire history of when the strategies do well together, when more than one strategy is actually recommending a particular stock. So this really generates new trading ideas using a very, very disciplined trading system. You can select the trades for you given the risk and return stats. I didn't show you, but on it, it shows you the average expected type of return, the duration, and any kind of risk or accuracy information we have on that particular combination of strategies making a recommendation. So you could choose just to go for the highest return, or you could choose to go for the least riskiest, the most steady, most likely return. But you do have that ability to make your trade-offs. And finally, this is something that can complement your trading of either baskets or funds. This is not an either or system. But a lot of people still like to participate in individual stocks, even if they've subscribed to thematic baskets or even if they invest in funds. And this gives you a very systematic, disciplined basis for picking out and investing in individual stocks.
Yes. So, for the benefit of the audience, this is the module that we are all awaiting very, very excitedly, and we hope to launch this in probably 2 weeks from now. Currently on the Alphaniti platform, as you will get to see, we have the US baskets and the strategies, but we believe that the single stock recommendation, as you saw, the US stock Genie is truly path-breaking, because the key advantage that Alphaniti is going to provide is the high quality advice, whether it is in the form of individual stocks, whether it's in the form of the baskets, or whether it's in the form of the strategies from our on the ground US partner. Now, this is completely in contrast to what you get to see today, which is purely execution driven service remotely from India. So that's a big advantage that we have, through this partnership between Alphaniti and Validea, and through the products and offerings that we would continue to bring to the Indian investors here. So, John, before I kind of close on this particular part of the session, I have one question for you. So, we've seen a lot of these strategies which work, and I mean, a lot of them are secular, a lot of them are trading, and they work for different time periods. But would you also have a long-term approach or philosophy to investing? And if you could share your thoughts around that.
I do have a approach, and it is long term. I do encourage, based on my history, my experience, my research, uh, investors do best when they have a very long-term investing view. A lot of people come into stock investing and they hope in 1, 3, 6 months that they'll double, triple, quadruple their particular value. And while that does happen and it provides a casino-like excitement, the best, wisest, and most successful investors are those that invest for the long term. The long term is you've got a vision of 10 years, 20 years, or more. And within that, you want to keep and basically have strategies that you keep for the long term. But let me share something with you here. One of the things that I've learned is you don't have to hold stocks. You don't have to hold individual stocks for the long term to be a long-term investor. You basically need to hold on to the strategies for the long term to be a disciplined and wise and successful investor. So once you decide, for instance, and hope based on the presentation today, you understand that value is in a great phase right now, and you decide that value type investing or ESG type investing is right for you, I'd like you to consider staying that for many, many years, not just for 6 months or not just for the balance of this year. You don't have to hold on to an individual stock there, as long as you're following a consistent pattern or discipline strategy for picking the stocks in those areas. So if you subscribe to one of the Alphaniti portfolios or one of the Alphaniti baskets, or even the trade alerts, you are still staying disciplined according to a long-term strategy. And you're just applying the rules to what's the latest stocks in the stock market today compared to all the other stocks and how they're doing. So another saying that I have is the time in the market is actually more important than timing the market. Over the decades that I've been doing this, I have found virtually nobody who in advance of big drops in the market can actually adequately time them, let alone adequately know when to come back into the markets. Those people who've successfully called big drops in the market, invariably, you look at the research and the history, they've had 3 or 4 calls that the market were going to drop before then. So you would have sold out long before their usually most current prediction. The same time for getting back in, most times if people get out, they're out for several years, not out for a few months. And the stock market can turn around in a long time, like over 3 years, or it can turn around in just a few months like it did last year. So this has been impossible for people to predict. And generally people who worry about the timing of the market are less successful than those who stay in over the years for the long term and try to hold diversified portfolios. Nobel Prize winner Harry Markowitz said, the only free lunch in investing is diversification. So diversification in stocks, diversification in strategies, and diversification in asset class. So those are the wisdom for long-term investing that I want to share with the listeners today.
Well, thank you, John, for those pearls of wisdom, truly priceless. So with that, now let me get in Akshay for a live demo of the Alphaniti platform. So Akshay, over to you.
Thank you, Arindam. A very warm welcome to all Adarsh residents. So as you can see in front of you, we have the landing page of the Alphaniti platform, which is there right in front of you. So this is an extremely easy to use platform for all our investors. All you need to do is register with us using your mobile and your email ID. And we have currently 3 primary products which are listed on this platform, which basically cover almost a majority of all the asset classes, which is relevant for investors looking for capital appreciation. So we have a mutual fund advisory service. We have a comprehensive product range across stocks for the Indian markets. And last but not the least, the most talked about topic today, US stocks. So under US stocks, we have all the baskets and the strategies which John has just spoken about. They are all listed over here. You can, register on the website. You can log in. You can check out all the, stats with respect to all these strategies which are there. As you can see, most of the strategies are long-term in nature. They have been listed and they have been performing live in the US markets for the last 12 to 13 years in some cases. And these are, mind you, live performances. This is not back-tested in any manner. So you have all the information available here for you to take a decision with respect to the US strategies as well as the baskets. Now, when it comes to picking and choosing any particular basket, we currently have a tie-up with Stockle, which is the Indian partner and Indian gateway for Drive Wealth, which is the US-based discount broker. So all any investor would have to do, or a user would need to do to participate in any of these baskets or strategies is to have an account with Stockle. If you are a new user, all you have to do is click on this yellow button over here, and the entire sign-up process with Stockle is completely digital and paperless. It's extremely easy. If you are an existing user, let me show you how this entire process works. It's very simple again. So all I have to do is log in to the Stockle platform using my registered email address. Yeah, and as you can see, our baskets are renamed as stacks on the Stockle platform. There are 3 main stacks which are listed on their homepage, which are all belonging to Alphaniti. You can get more details about these stacks over here. So as you can see, the 3 baskets, the ESG basket, the brand and the moats basket is also listed, as well as the healthcare leaders. Apart from this, we also have our twin momentum as well as our Mohan Ram strategies listed here as well. If you want more details on how to invest in these baskets, all you have to do is just click on the product, and you can get all the details over here as well with respect to performance of that particular stack. You can buy it. The minimum ticket size is $1,000. You can do in multiples of that, and you can invest over here for an average annual fee. We charge an annual AUM fee of roughly, I think, 150 basis points, and that's inclusive of everything. There are no other charges over and above this in terms of performance fees or whatsoever. So it is as simple as this when it comes to investing in the US stocks. Similarly, for India as well, I would like to say that when it comes to the stocks Genie US, which John just spoke about, and we are very excited about that product, which we will be launching soon. In fact, probably by the end of this month, it will be launched on the Alphaniti platform. That will be available to all users for a very minimal subscription fee. It's going to be a flat subscription fee, which will have a validity of 6 months. Those trade alerts will be available on this platform alone, and you would be free to trade in those stocks with any broker of your choice. You are not limited to Stockle. If you have an account with any of the other US-based brokers like TD American Trade, or Interactive Brokers for that matter, you can trade through any of the brokers. But all those alerts, all the stock ideas will be available on the platform Alphaniti. Similarly, for the Indian baskets, we have come out with a stocks Genie algorithm, which basically runs ideas from anywhere up to 2 months to 2 years, and it straddles across the market cap segment. So we have large cap, mid cap, and small cap ideas as well. We also give you additional data points over here, which will talk about what are the odds of you actually making money on this stock. So there is an 84% chance that you will actually make money on the stock and it will hit its target price. We also try to describe to you, what is the attractiveness of this trade for you. So the risk on the table is 1 versus the reward being 6. So it's an extremely attractive risk reward ratio, which is available for the investor. So we believe that these 2 or 3 critical data points for the investors are extremely crucial for them to help them to take an informed decision. Similarly, we also have thematic baskets. We have 9 thematic baskets which are listed on Alphaniti. You can click on any one of these when you're registered. You can go through the strategies and the baskets. You can have a good look at it. In case you want to purchase any of these, the investment process is extremely simple. All you have to do is click on invest now. You can put in the amount of your choice. For example, if I wanted to invest, let's say 50 lakh rupees in this particular basket, all I have to do is just key in the amount, place confirmation on order, and I can select any of these brokers. So currently we have about 10 odd brokers. This list will be expanding to close to 20 to 25 brokers over the next 2 to 3 months. Very, very rapidly. We would be signing up with a lot more of the major execution partners in India as well. So once you click on any of these brokers, you would be able to complete the execution of this entire basket at a single click. So that's the value add that we bring to the table with Alphaniti. So that's it on Alphaniti, and over to you, Arvind.
Thank you, Akshay. Well, as we demonstrated, the Alphaniti platform has been built to drive digital transformation in the investment domain and capture, as you're aware, this entire mega trend of investors getting rewired, and with digital propensity now starting to span across all investor segments. So it is no longer, confined to a section of the investor segments, but whether it's the mass affluent, whether it's the HNI, ultra HNI, the family offices, everybody is now getting to be digitally native, and that is where Alphaniti comes in. And in this journey, from disruption to transformation and mainstreaming of direct investment, our goal is to try and see how we can increasingly offer these high value accretive products and solutions by leveraging on deep domain expertise, technology, as well as big data. But what is significantly important to note is that there are two massive path-breaking disruptions which are happening here. The first is Alphaniti has the capacity to churn high-quality automated offerings at much lower cost than competitor products. That's one. And then it is also leveraging on technology to reach these products out extremely efficiently at high speed to investors across the globe. So this is about Alphaniti. And apart from this, we also have a very specialized advisory desk called AlphaMind, which is meant only for family offices and ultra high net worth investors. So here we provide curated and high conviction portfolios with very, very sophisticated and holistic solutions. In fact, we have a growing family of investors from Adarsh itself in our AlphaMind offerings. And we would definitely be delighted to extend this service to each and every member of this very exclusive and elite community. With that, let me bring in Akshay again for an insight into AlphaMind.
Right. Thank you very much, Arindam. So as Arindam said, AlphaMind is an offering which is designed exclusively for ultra high net worth individuals and family offices. What we do over here is we have an extremely experienced investment committee team, which have basically between them collectively we have about 100 years of years experience traversing the Indian markets. Uh, we bring all of this experience together to uh, construct curated portfolios for our clients. So within this, the first product that we came out with early last year was the AlphaMind Industry Leaders portfolio. It's an extremely simple offering. We try to build a concentrated portfolio of anywhere between 12 to 15 large cap or mega cap stock ideas, primarily from the Nifty 50 or Nifty 100. And we the entire focus over here is not to chase performance, but our first goal and objective is to manage the level of risk for clients. So the focus is more on protecting the downside, and the upside when it comes, well, that's a bonus for us. However, it's very safe to say that performance during bull markets have been satisfactory for this product as well. Now, in terms of how we are positioned in this particular portfolio as of today, given that we are already at life highs, uh, and that this slide in front of you would answer that question. So as you can see, yes, we are a little defensively poised in our portfolio construct. As you can see, we have about 15 to 18% of cash plus gold bees. We have about 23, or rather, I would say about 40% invested across healthcare and telecom space. Our allocation to financials was actually pretty high up till mid-Jan. And over the last 1 month, we have actually trimmed down our exposure to financials. And in fact, we have increased our allocation to oil and gas. But actually, to be honest, it's one single stock in the oil and gas space where we have invested 21% of the model portfolio. And that's a special situation. We believe that there is a significant upside to be had over the next 3 to 6 months in this particular stock. And that's why we have made a disproportionate allocation over here. But what I would actually like to talk about more in depth today is while we have the industry leaders portfolio, it's done well over the last 12 months, but we see a massive opportunity coming in the small and mid cap space. And like John had just earlier, touched upon, how small cap stocks are performing extremely well in the US markets. Well, let me tell you that this is a global phenomenon, and it's a phenomenon which is applicable to the Indian markets as well. And the reason is this. If you see the chart in front of you, this is basically nothing but the BSE mid-cap index relative outperformance versus the Sensex. So basically, it tries to capture how mid-caps are performing versus the mega caps in the Indian stock market universe. And as you can see in front of you, this index actually topped out somewhere in 2018. You had a significant correction. in mid caps. They became pretty cheap and they remained sideways for about a year or so. We have just started inching up again, and we believe that this outperformance is here to stay. We have a similar graph over here for small cap stocks, and small cap stocks are basically defined as anything with a market capitalization of less than $1 billion. In Indian context, it would be probably less than 5,000 crores of market capitalization. And as you can see over here, we hit the top in 2018, early 2018. The index completely collapsed. We are in the midst of what we believe to be a secular bull run, which has just begun and is likely to continue in the years ahead. And this phenomenon is even common to the US markets. As John had pointed out in his earlier slides, I would like to show you something which is very interesting. This is the Russell 2000 index. The Russell 2000 index is the equivalent of your mid cap or small cap indices in India. It basically belongs to all the emerging 2000 odd companies which are listed in the US. And the relative performance of this particular index versus the Dow Jones. As you can see, there is a vertical liftoff, if I might add. But what we believe is that this is actually a very, very important threshold, and which we are about to cross over. And probably this is going to continue in terms of outperformance. This barrier has been relevant since 1988. So it's a 30-year barrier, and we are about to break it. So you can only imagine the kind of sustained outperformance that we are going to see, not only in India, but even in the US markets when it comes to small caps and mid cap stocks in the coming years. And this is the same story even in the NASDAQ. So what you see in front of you is an index which comprises of all the small and mid market capitalization stocks listed on the NASDAQ versus the top 100 stocks on the NASDAQ. That's the NASDAQ 100. And as you can see over here, there was a complete collapse going into the pandemic, and we have just about begun the recovery over here, which is taking shape. So in a nutshell, what I would like to highlight is this, that we are cognizant of this emerging opportunity. We will be launching a small cap, mid cap focused advisory product very, very soon. And we believe that the landscape for investing in mid caps and small caps is going to be extremely rewarding over the next 2 to 3 years. And this is not all. We are also launching a second product over and above the small and mid cap product. The second product is going to be basically focused on special situations investing in India, whereby we are going to invest in special situations such as delisting offers. We are going to invest in distressed opportunities where stocks are trading well below book value. And we are also going to look at stocks which are basically trading at very, very deep discount to their inherent, the inherent value in their business. So there are going to be lots of such opportunities which are going to come up, and that particular product would focus on investing in these particular segment of ideas. So yeah, that's it from me, and over to you, Arindam.
Yeah, so I think with a series of rollouts being planned right from mid caps, small caps to the US stock alerts, we've already rolled out the India single stock recommendation engine. I think this is really going to make it extremely compelling, as a platform and as your preferred choice for taking care of all your investment needs. Let me now turn to my other panelist and co-founder, UR Bhatt. Mr. Bhatt, as you know, global markets are at lifetime highs, right? And the dilemma with most investors is what should be the strategy for investing when markets, are at their peaks. And of course, here we are talking of the frontline stocks and not the broader market. But for someone like you who's lived and worked through so many market cycles, right, over the last 3 decades and more, what would be your advice to investors now?
Well, I think the received wisdom is that we should really be buying the market at when the market crashes, and selling when the market peaks. This is probably the ideal situation, but uh, typically when the market collapses, there is so much of fear in the market that there are very few buyers other than sort of probably professional and institutional investors who have the guts to buy when the market collapses. But most often, most investors, whether it is retail or high net worth individuals, they tend to sell when the market collapses. But if you really see the graph of the Nifty or the Sensex over the last, whatever, 25 to 40 years, 40 years for the Sensex and 25 years for the Nifty, this is where it is. This is a Nifty index chart for over the last, say, about 25 years. You can see only a graph which is sloping upwards with some kinks in between. And these kinks are somewhat pronounced sometimes, say, for example, in 1995, 2000, 2008, and last year, 2020, March, there were some kinks. But as you can see, in the long term, if you see this graph, they are just kinks. So therefore, if there are traders who want to profit from these kinks, and so therefore you buy low and sell high during these times. But it is something that it is a fool's game. In fact, if you really see, most of the traders, I mean, probably more than 60-70% of them lose money by trying to time the market. So for investors who are not full-time into the markets, it's always a good idea not to time the market. And what is the situation if, say, for example, you are investing at market peaks? Let's go to the next one. So if you really see, every 1 in 20 days, that is about 5%, there is a market high. I mean, on an average, every 20th day, there is a market high. And if you don't invest during that time, when are you going to invest? So if you invest in during market peaks, that is 5% of every day the market functions, the market peaks. And so therefore, if you invest at market peaks, 1 year from then, historically you have seen, you earn 9%, 3 years, 30%, 5 years, 57%. So it is not as if you invest in a market peak, it is the end of the world. You can, because it is a upper sloping graph, you will always make money. It is just a question of, sometimes for the peak to be reconquered, it sometimes takes some time. Typically, say, for example, even if you see in March 2020, when there was a 40% drop from early March to the end of March to 2020, the market recovered whatever, the 12,400 something in early March in a matter of 3 or 4 months. So therefore, it is not as if it takes a long time for you to recover and produce returns. And if you see the long-term 30-year average of return of, say, for example, the Sensex, it has given you about 14% CAGR. And this without considering dividend. And the dividend itself is probably about 1.5%. So you are actually making about 15.5% compounded annual return over the last 30 years, when the average return on a fixed deposit would have probably been something like about 7%. And of course, that is fully taxed, whereas here, if you don't keep on trading, it is not even taxed. I mean, only from last year, it is even long-term capital gains are taxed, but I mean, there is minimal taxation as it is. So therefore, it is not a great idea to time the market. You should always be investing regularly, and investing at market peaks is not exactly a death warrant for investors. You can really make money when you invest even in market peaks. And if you really see the history, market peaks have not prevented you from making a reasonable return. So therefore, I mean, the sum and substance is that timing the market is a fool's game. Let us not time market. There are people who keep on timing the market, and quite often they get it wrong. So, but I think as investors, we should really be concerned about how we fare, how we build wealth over time. And for that, any time is a good time to invest. Over to you, Arindam.
Yeah, as I say, therefore, there is no right or wrong time to invest. I think one should stay invested at all times, because if you're not invested and the market starts to move up, then it is almost impossible to kind of, take advantage of that and ride the upside. So one more question for you. So we recently saw, the budget being announced, and it's been a reform-oriented budget which has been announced with the government determined to spend like never before, clearly with the objective of driving demand growth. So, what, according to you, are the top three measures which would help us to stay on course to be a $5 trillion economy?
Well, I think it's one thing that we really have to see is that budget has provided an opportunity for most investors to lose money. Because if you see over the last 25 years, 16 out of the 25 years, after the budget, the market has lost, market has corrected. It's only 9 years out of the last 25 years that the budget has made a difference to the market. The market has come out to a winner. Even now, if you see from the peak about a few days ago, the market is the Nifty has corrected about 500 points. But even then, from the date of the budget, we are still about 10% up. Now, why is it that only rarely do markets appreciate the budget? Because generally the expectation of the budget is so high that the budget, no finance minister can deliver on those expectations, and therefore there is a disappointment after the budget. But in this particular budget, February of 2021, what we have seen is there is a refreshing change in terms of dealing with the economy. The government has taken on itself the task of enabling businesses to service the demands of consumers. Because instead of being in business, instead of actually providing it itself, except of course for the lowest strata of society, what the government has said is that my job is as an enabler. My job is not to run the economy. The businessmen and the entrepreneurs will run it. But I have to ensure that there is fair play, and I have to ensure that it is enabled. So therefore, I think the biggest enabler a government can provide is building infrastructure. So therefore, even here, if you see, the government actually is an enabler in creating infrastructure. It is actually ensuring that they lay the ground rules, Niti Aayog and company lay the ground rules, and then through a competitive mechanism, they invite entrepreneurs to build infrastructure. Because if there is a huge difference between us and the developed markets, it is in the level of infrastructural support services that are available in India. So I think the biggest thrust of the government this time, the budget this time, has been to create infrastructure. The second very important sort of differentiator this budget over the previous budget is that the government has had the guts to use the P word, which is privatization. Till now, you would always see that there will be some divestment of 5% of that company, 10% of this company. So it doesn't change anything, because finally, as the Prime Minister himself has said after the budget, that it is the bureaucrats are not the best guys to run businesses. And so at least the government has at last realized this, that 5% divestment of a company doesn't change anything, because it is still the administration is controlled by the bureaucrats and the ministers. So therefore, it is the privatization that will actually create value. And if privatization is not done, but the particular sector is opened up, like what you have seen in telecom, in airlines, what happens is the PSU gets killed virtually by the private sector. You can see this in Air India, you can see in BSNL and MTNL, because these are companies which could not compete, being controlled by the bureaucrats, cannot compete in the private sector. So therefore, the government has now decided, of course, in a small way, to actually privatize these companies, whether it is banks, whether it is oil companies. So they have decided to privatize, and that is the only chance you have of getting into your market economy and being just an enabler. So these are the two important changes that they made. The third one, of course, is to ensure that there is some sort of predictability about taxation. So they have not, if you really see, they're not meddled with taxation too much. And of course, the indirect taxes now has been subsumed by the GST, and the GST changes, if any, are decided by the GST Council. So therefore, the budget doesn't have too much of a significance as far as indirect taxes are concerned, except in a few products where there is still you have customs and excise. But the fact of the matter is, as far as direct taxes are concerned, I think India's taxation structure is as competitive as, in fact, probably more competitive than most other economies in the world. Of course, there is not so much of social security in India, so therefore there's every reason why taxation should be low, and that is why it is low. I mean, at personal taxation at 22%, and even at lower for corporate taxation, I think it is the most competitive taxation regime that you can get. So therefore, the whole budget now this time has been juxtaposed on, is supported on these three pillars. One is to ensure that the government is an enabler to create infrastructure. to privatize and to get out of business, and third, to give a predictable and stable taxation regime. And I think they have done a very good job of this. And that is why you have seen that post-budget, the market is still, because even before the budget, everybody was saying that, well, the market is at its peak, so therefore we should get out. So if we had got out, we would have probably missed a further rally. So therefore, as to sort of marry this with the earlier question that you asked about market peaks. So the received wisdom just before the budget was that, it is time for us to get out, because the experience has been that after the budget, the market corrects. But this time the budget was different. So there was a refreshing change in attitude towards business. And so therefore, I think the budget has given a good fillip to the market. And the market probably has corrected a bit over the last few days. But I don't see any dramatic change unless interest rates start moving up dramatically. As long as interest rates continue to be at these levels, and as long as there is enough liquidity in the market or in the economy, and there is new liquidity measures being undertaken even in the US for now. So therefore, I don't see any dramatic threat to the market immediately. But I think one has to keep a close watch, and that is where we think that there should be someone who thinks about the market, who thinks about your portfolio all the time, because you are in business, you are employed. So therefore, it is very difficult for an investor, for a part-time investor, to really look at this all the time. So therefore, you have it's a much better idea to give it to those people who have a lot of experience in these, and monitor these portfolios all the time, and effect necessary changes, and ensure that you generate a good long-term return. Over to you, Arindam.
Excellent. I think, as the Amazon chief, Jeff Bezos, he recently said that this is truly an Indian century, right? So that is, I'm sure, what keeps us restless and keeps us awake, through the night, with all the immense and mind-boggling opportunities that is yet to unfold. So with that, let me now throw the session open for question and answers. We do have a long list of great questions, and we'll try to attempt to answer each of these. So Akshay, would you like to?
Sure. I think we have a couple of questions on the US market, so I would appreciate if John could also help in answering these. So the first question we have is looking for a basic thumb rule in terms of how much percentage exposure in equities to US markets should an Indian investor have. So for example, we all have thumb rules on asset allocations between debt, equity, gold, and other asset classes like real estate, right? But how do you decide within equities how much should I have abroad, how much should I have locally?
Yeah, I think, it's always good to have a thumb rule in investing. And as you said, we always need to have some asset allocation guidelines, whether it is equity, debt, gold, and other things. But even as a matter of fact, US, international investment and Indian investment. One advantage as far as India is concerned, investing abroad, is that if you say historically, over the last probably 5-6 months, things have been different. But otherwise, over the long term, the Indian rupee has always depreciated, and depreciated on an average CAGR of about 4 to 5%. So even if you make slightly lower returns internationally, still when it is converted into Indian rupees, it is still a good return. So and since you have $250,000 that you can send every year through the RBI scheme, I think it's a good idea to invest abroad. But either it is $250,000 for those who have to depend on the RBI scheme, and those who don't have assets overseas already. That is the sort of limit. And so, but in any case, I don't think in the equity portfolio, I think typically it should not be more than about 20 to 25% of the investment should be in international investment. It should not be more than that, because if you see, the US or the international markets and the Indian markets are not exactly correlated. They're slightly negatively correlated. So therefore, it's a good idea as a diversification sort of tool to invest also in the overseas market. And I think the US is probably the better market among them, because the US still has recovered from the pandemic much faster in terms of the market and in terms of what they have done to the economy and the proactive steps that the government has taken than other markets. So therefore, I think it's a very good idea to invest about 20 to 25% of the equity allocation in your total asset allocation scheme to international markets.
Thank you. That's a very good suggestion, Mr. Bhatt. The second question we have today is, so we have seen that US stocks don't seem to have any upper or lower limits, which is second nature to investing in India, right? Only in index stocks in India you don't have circuit filters, but in the US it's scary to see cases like GameStop, etc. Right? So how should we advise to the Indian investor who's looking at investing in US markets? How do they sort of protect themselves from such incidences where you see stocks going up 400, 500% in a single day?
You ask a interesting question. First of all, it's certainly rare that you see a stock going up, 100% in a week, let alone a day, or down there. We've done several studies on setting stop losses and what is the appropriate price to do that. We looked at setting stop losses at 5% under, where it is 10%, 15, 20, 25, 30%. Much to our surprise, we didn't find any particular number that resulted in an economic benefit. What we found is, although setting narrow limits got us out early on the stocks, there were just as many stocks that may have penetrated that line and then come back to went on to new highs. So on balance, it really surprised us that setting the limits did not help a portfolio. That said, when we manage money professionally for institutional clients, we will set according with their policies, which often are like 20% stock loss limits. It's easier to explain to the client, hey, you got out at 20%, that was the worst loss that you had. Then overall, yes, we had some losses at the current time. Okay, it's down 34%, but then it comes back up and makes it. So for individual investors, don't set it too narrow. Otherwise, they're going to be triggered much more often than you would like. 20% is probably a reasonable loss. And in terms of an upper limit, probably increasing it 20% from where it is currently will be a good rule of thumb to do that. You may either have a target price or again, you want to keep raising the limits. Ideally, you'd like your stock to run over a period of time. The other way I need to answer that is not just the upper and lower limits. We look at overall strategy. So if the strategy says, if a stock meets the criteria for buying it, you buy it. When it finally falls out of that category and no longer meets the criteria, that's when you actually remove it, not when the price actually falls below a certain point. So it's very different philosophies. And I'd encourage you, probably the more sophisticated one is to adopt the lower one. Keep with the strategy. Maybe if you want to have a 20% lower limit, but the time to sell it then is when it no longer meets the criteria of the strategy under which you invested it.
Right. Thank you, John, for that elaborate answer. The third question we have today is the thumb rule for long-term equity returns in India is roughly 12%, give or take, right? What should a long-term investor in India consider the expected returns from, say, investing in the US markets? Obviously, we have to take into account that there would be the currency factor as well. So there would be an added tailwind of about anywhere between 4 to 5 percentage points, as Mr. Bhatt had pointed out. But over and above that, in dollar terms, John, in your experience, what have been the average compounded returns for the frontline indices?
Over the last 100 years, the returns in the U.S. market compounded have been about 9 to 10%, depending on exactly what period of time you start to measure it and over how long. The only thing I would caution is, my experience is there has been very relatively few times that the US stock market has returned the long-term average. 50% of the time, it's either up over 16% or down worse than 16% in a year. Maybe only 5% of the time do you have anything within a few percent of the 9 or 10% long-term average. So as much as I understand why you're looking for a long-term return on any year-to-year basis, you're not going to see it. But in direct answer to your question, bottom line, without looking at the currency exchange factors, which, as you just heard, is about adds another 4 to 5%, you're looking, let's say, approximately 9% per year compounded.
Great, that's very helpful, John. So basically, if you look at it, it's about 9% plus another 400 basis points. So that's about 13% kind of compounded returns is what one can expect over the medium to long term from investing in the US markets. This is for obviously an Indian investor residing in India. The next question we have is, could you help us to understand the returns for all the strategies for years prior to CY20? Okay, so let me just take you through the platform and you would be able to see where exactly all the statistics are present. So if you go to US equities, you see these tiles in front of you. The dark blue ones are the secular strategies. The light blue tiles are the thematic baskets. Now, if you wanted to see what has been the performance of, let's say, the twin momentum strategy, one is obviously you have the performance graph, which is valid from 2009. That's when it went live. Secondly, there is another performance stats graph right below this one, where you can see the outperformance every calendar year for the said strategy. So as you can see, it was a massive outperformer in the year 2020, right? So this is where you can get to see how the performance of every single product that is listed on Alphaniti, how it has performed over different years. Right. Moving on to the next question. Okay, can we elaborate the method? Is it human research? Is it machine learning? Behind the trade alerts system. Right, John. If you could just elaborate on how this system is designed.
It was actually designed using statistical research. We looked at our historical database for each individual strategy, and we looked at the performance of the joint recommendations in various combinations when 1, 2, 3, 4, 5 or more strategies selected the stock at the same time, and we measured the outperformance. So no, it's not using machine learning to do it. It's based on our long-term statistical analysis, true and tried research methodology for identifying the best predictive combinations and then turning that into an alert system.
Great, that's useful. Thank you, John. So I would like to also add to all our users that it's basically on similar lines that we have also developed the stocks Genie trade alerts mechanism for the Indian markets as well. All right, moving on. Would be good to hear about a quick few words on the tax consideration of the Indian investor who is investing in the US markets. Mr. Bhatt or Arindam, would you have any insights to give on this particular question?
Well, I can speak on this. Well, I think as far as tax is concerned, there is always a disclaimer that you have to consult your own tax consultant on these issues. But broadly speaking, what you have to do, I mean, whatever returns that you get from there and whatever you realize in India, on that you will have to pay Indian income tax. And as long as there is a double taxation avoidance treaty, you can reduce from that whatever taxation you have paid in the investing country. This is the general principle of taxation. Specific issues, I think you will have to consult your tax consultant.
Yes, right.
I think, Akshay, there is one more question, which is on whether we have plans to come out with a with a portfolio which comprises of both India and US stocks. So the answer to that is a big yes. Definitely, it's kind of been on the active part of our implementation and rollout. We've been tracking this portfolio, the model portfolio, for quite some time, and at an appropriate time, very soon, we would definitely be coming out with a portfolio which would cover both Indian and US stocks as well.
Thank you, Arindam. Okay, please comment on passive in index fund based investing versus actively managed funds. Mr. Bhatt, I guess this is probably for, I guess this is for the US market. So probably John is better equipped to answer this.
Re-ask the question then.
Yeah, the question is, how do you rate passive or index fund based investing versus actively managed funds, or in this case, I would presume actively managed strategies, stock based strategies?
Over the last probably decade, passive strategies have done very well, particularly in the United States. Basically, what that has done is pick various segments. You have the tendency of the United States stock market to go up. And over the last 10 years, it's been a period where it's favored larger capitalization stocks. Those tend to dominate most indices. Most indices tend to be weighted toward the larger capitalization stocks, not equal weighted for all of the stocks in it. That said, we have we've determined, based on research of the strategy, our own research, that what we will call these actively managed stocks, at least actively managed by computer wisdom. It's you're putting the rules into the computer for strategies that have worked over very long periods of time. You're applying those rules to the entire set of stocks in the stock market, not just an individual stock that comes to manager's attention. The computer active strategies also tend to do well and have the potential for outperforming the passive strategies. So I have been and continue to be a big believer in active strategies when those strategies are controlled by the computer wisdom, not by individual portfolio manager minds.
All right. Thank you, John. Great. So the next question we have is, and I guess this is for clearly the Indian markets. So Mr. Bhatt, the question here is, what's the best way to capture the infra story? Would it be capital goods or EPC, or is there some means to diversify? How would you play this?
Yeah. One thing that is very clear is that there is a lot more of infrastructure that is going to be built in India. And with the sort of fillip that the government is doing, I think infrastructure is a reasonably good story to play. Now, infrastructure is, I mean, there are various elements to this. There is someone who builds the infrastructure, which is the EPC contractor. Then there is someone who provides him the machinery, which is the capital goods manufacturer. And then there are materials that are used in the infrastructure story. So therefore, these are the three elements. Now, all the three elements are important. So it is not as if you can just buy the EPC contractor and say that everything will be fine, because there are so many issues as far as the EPC contracts are concerned. Quite often they make reasonably good return, but when there are some issues with delay and there is penalty and all that, and sometimes they don't get paid in time. So I mean, there is a slightly larger element of uncertainty as far as EPC is concerned. But there is a much lesser element of uncertainty as far as the materials is concerned, because irrespective of whether it is delayed or otherwise, all the material has to be used, whether it is cement, whether it is steel, whether it is bricks. But the capital goods manufacturer, his capital goods, his machinery has to be used. So therefore, it has got to be an eclectic mix of these things. And I think the best companies in these particular sectors, where you have to really go to the bottom of how they can perform, the valuation, the business opportunity, the competence of the management, and how well they are equipped to meet the particular segments of the infrastructure that are actually being given a fillip. I think these are the issues that need to be analyzed, and then you have to come to a stock portfolio. I think that is where some skill is required, and that is where we think that we have, with our experience, we have we have something going for us. And that is why I think we cannot really say that you put 10% here, 50% here, and 40% there. I don't think that is the way the formula works. It is with respect to specific company, with respect to specific opportunities in the infrastructure space, that we will have to construct portfolios.
Understood. That's a very good suggestion. All right. So we have one more question over here from Mr. Anand. What are the parameters based on which you pick a stock? Okay. Let me take this one. So this is actually a pretty broad question. But to answer this, so there are various ways to skin the cat, right? But the way we sort of have modeled all our strategies is on the basis of defining the set of rules for a particular strategy. So once we have defined the rules, we will operate within the parameters of those rules. Whether it's a growth strategy or a momentum strategy or a value strategy, we would define the hard parameters and boundaries on the basis of which a stock would be picked. And the parameters would be straddling across fundamental factors where we are analyzing the financials of a company, the balance sheet, the profit and loss account, the cash flow statement, and as well as we also have a look at the valuations as well. We also look at a combination of technical factors, the price volume analysis, so on and so forth. So it's a complete universe of, I think, roughly 250 or 300 odd cross-sectional parameters that we are monitoring across each stock, whether it is across annual results or quarterly results, you name it. We also have a team of analysts which also undertake thorough due diligence of the companies which we include in our Indian baskets. So that means attending conference calls of companies, being up to date on developments across the companies in India, so on and so forth. So there is definitely a very elaborate system which we have designed in-house, which goes into the process of building out these strategies and baskets. And of course, the most important element of these products is the concept of periodical rebalancing, which happens roughly on an average every quarter. So that is, I think, the last question we had from the audience. In case if there are any other questions which have come to you separately, Arindam.
Yeah, I think that's all that we have, for today. I think it was a deeply engaging, interactive, and extremely satisfying session that we had. Would like to thank the Adarsh residents for taking their time out on a Saturday evening. So each one of you, thank you very much. We thoroughly enjoyed presenting Alphaniti as well as Alphamind to you. A big thank you to all, my co-panelists, including John, who took the time to be on this session, despite the very early hours from New York. We really look forward to fulfilling your investment needs, as we said, by bringing in best-in-class products, and innovations is something which is very integral to whatever we keep doing. And we believe that this blend of deep domain expertise, big data, and technology, our partnership with Validea, these are clear value adds which allows us to bring in high value accretive products and solutions for our investors in India. And we definitely look forward to seeing you in person and also on the platform, and look forward to building a great association with each one of you progressively through Alphaniti and our offerings that we bring in the future. So thank you very much, and have a very good weekend, and good night.